It has been a few weeks since I dropped a video on my observations of markets, the things that have caught my eye over the past few weeks. So I thought I would jot down a few thoughts about things that I'm finding interesting, things that I think are of vague importance. And the first thing I want to talk about is our local market. And I'm going to take a little bit of a diversion here in a minute. The thing I want to talk about is this notion of percentage change. Percentage change is a relative measure, not an absolute measure. It is therefore the most important measure. And the reason I'm highlighting this, and this is my little diversion, is that in commentary on the US market and their session on Friday, everybody was somewhat over the moon that the market was up 564 points. Now this sounds to be an awful lot. This is a very big number. But it's not such a big number when you consider that the Dow actually began the session at 33,248. In terms of its relative performance, it was only up 1.65%. It is the relative performance of markets, both against their previous performance and against other markets, that is the most important metric you see when you're looking at what a market has done. This notion of how many points is an irrelevancy. It's not that important, and only amateurs focus on that as a metric. So back to our market. This is a weekly version of the chart I just showed you. And so we're looking back 5 weeks at the relative change in the ASX 200. And as you can see, a quick bit of mental arithmetic tells you that the market really hasn't gone that far in the last month and a bit. And we can actually see this when we actually move to a price chart. We are caught with this somewhat perennial problem of the local market that it is stuck in a band. And it really shows no sign of moving outside of that band. And to a degree, this falls back to the conversation I had in the last video on congestion. This is a problem for traders because it gives us no clear measure or no clear breakout to trade. Yes, this is a fairly wide band. And it's a band of about almost 1,200 points, but it is still a band nonetheless. And we can see this more clearly when we step back a little bit. So a point of interest for traders, always take a step back. This is a weekly chart, and it gives us this very, very clear impression of where the market is topping, where the market is bottoming, and how we're stuck in this zone in the middle. And this does have implications for us. This is problematic for us, in that it means that the constituents of the market are not moving, and they're not moving to any great degree. We're not seeing any explosive movement. If we were to use a very loose generalization of bull markets, the last thing approximating a bull market that we had here in Australia was the pop we had from COVID. And that was the last time. Since 2021, the market has simply gone sideways. And this has largely been reflected in the stocks that make up the ASX 200. This point will become important in a moment. But in terms of trading as a point of interest, about the only thing I can say about the ASX 200 is when we do something different. And by different, I mean reduce the time frame. This is a true trader's chart. This is not a chart for an investor or someone who takes position trades. You can see the time scale. This is a 4-hour chart. And you can see in part the somewhat fractal nature of markets in that resistance is replicated on all time frames. And so if I were looking to trade the index itself, not the components of the index, the key point for me would be the breach of this mark here, this blue line I have, that sits just below 7,400. That for me is the key point. Anything other than that is really just, let's call it mucking around the edges. And that is problematic for traders. Traders spend a lot of time wasting their time on noise. And again, this comes back to something I spoke about in the congestion video. Noise kills traders. We need to look for the signal within the noise. And sometimes that means waiting. But I'm now going to make a point that will upset a lot of stock pickers. And it is simply this. Markets matter more than shares. And by that I mean being in the right market at the right time is more important than being in the right share at the right time. Case in point, if you had gone back, let's say to 2020, 2021, and you had bought the first 10 lithium stocks you had bought at random, you would have done very, very well. It is doubtful that any amount of selection criteria you brought to that would have made a difference in your performance. What was driving the performance was the bull market in lithium stocks. It is more important to catch these broader moves than it is to spend your time desperately looking for the one stock that might give you a 10-bagger return. As a point of historical context in terms of our domestic market, the last real bull market, and not the COVID pop, that the Australian market had, in my opinion, that was broadly supported across the majority of the market was 2003 to 2007, which ended with the GFC. It's been almost 20 years since we've had a true bull market in Australia. This meandering up we've had post that time is in many ways a function of the construction of the index, in that the majority of the heavy lifting for our market in terms of the way the index moves is done by the top 20. The majority of returns from an index, and not the individual shares, comes from a tiny handful of stocks in Australia. That's simply a function of our market. So what's the implication of this for traders? Well, the implication is that if you spend all your time searching the ASX 200 or 300, it is highly likely that you are going to miss out on many of the opportunities that the Australian market presents. It has long been my contention that the Australian market is little more than a special situations market. And by that I mean it has these small pockets, such as the lithium sector, such as gold, such as the resources in general, that do very, very well at certain points in time. But it's also a narrow segment of that market that does very, very well. There is little point being a resources trader and buying Newcrest and Rio and thinking you're going to do very, very well. You might have positive alpha, but you certainly won't get the inordinate gains that you see in some of the smaller stocks. So if we look at, well, perhaps the best representation we have of resource stocks in Australia, the small resources, you can see that there has been, since 2003 to 2004, a collection of bull markets that have run for various amounts of time, each of these providing traders with a variety of opportunities. But there is a catch in this, and the catch is survivor bias and its related issues. If we go back to our ASX 200, what will happen is that people who scan this index and the 300 and the All Ords will go, well, my scan would have picked up Chalice Mining because it's now in this index. Yes, it's now in the index. It wasn't in the index when it took off. There is a profound degree of rotation within Australian indices. The ASX 200 on any given year can turn over 20 to 25% of its components. That's a reflection of the small size and illiquidity of the local market. So a stock such as Chalice or De Grey or any of the lithium stocks will only appear in the index after it has taken off, after it has, I'll make a bold statement and say, made the majority of its gains, and it's now becoming a portfolio component for various managers. You would not have seen it when it took off because it was not part of the market you were scanning. And so if we come back to this, whilst this is a representation of, or the best representation we have of that sort of scenario, there will still be instruments within this index that were not a component of the index when they took off and made a great deal of their running. The implication of this is that you have to be very careful with the parameters you set up for any form of scan you run. The scan you run in some ways will largely dictate the performance of your portfolio. And by that I mean not as a function of the indicators you use, whatever your breakout might be, whatever your moving average might be, but rather in terms of the universe you scan. It is immensely important to pick the right universe. And in terms of things that have caught my eye, first one, European lithium. We have this broad band of resistance between 11 and 12. And again, we come back to that notion of waiting, of patience, and simply waiting for a stock to move beyond a certain price point. The point I will make for people is that if your system is dependent upon you buying a stock at 9 as opposed to 9.5, you've got a pretty crap system and it lacks any form of robustness. But there is a point about this, and this is a general education point that I'd like to point out for people. Notice there is a difference between the right-hand final third of the chart and the left-hand first two-thirds. Notice how scrappy price looks in the first part of this chart. That's a function of illiquidity. The cleaner nature of the chart as it appears in its latter part is a function of more investor interest. This is a very, very important sort of dichotomy that occurs in these sorts of charts. They move from being scratchy and rubbish to all of a sudden taking on a much cleaner appearance. You'll notice the number of rejection tails in the first part of this chart. Again, that's an uncertainty over or a lack of consensus as to what price and trend should be. You can see they, to a degree, are starting to dissipate, and particularly in this new breakout, we have a sequence of much cleaner candles. Similar thing with Black Cat. We have this breakout of, let's say 45.50. But again, we need that movement beyond a given point before we have any form of edge. Otherwise, we're just taking a punt. And whilst taking a punt seems interesting and exciting, it's not that profitable. So if we move on to a bigger picture, and this is coming back to this notion I spoke about of markets and their secular bull markets. This is a Russell 2000 US index, a very large index. You can see the number of true bull markets this market had. Compare this to our earlier chart of the ASX 200, where there was a single point, 2003 to 2007. The interesting thing about that period for market comparisons is the Australian market was one of the best performing markets in the world for that period. Since then, it's been quite lackluster. And if we narrow down our focus, this is just the S&P 500, the benchmark that everybody should be using, not the Dow. We can see a similar pattern. We can see almost a continuous upward movement for 2 decades, a very different picture to the local market. And when you look at the components of the S&P 500, their trends are much cleaner than you would see in the ASX 200, the 300, or the All Ordinaries. And so if we look at the performance of the US market, again, this is weekly, so we're looking back a few weeks. You can see, once again, quick bit of mental arithmetic, market's gone nowhere for quite a while. This is an important point and is a very interesting one. As it shows up looking like this, these are very interesting patterns because they're nexus points. They're points at which traders decide whether to be bullish or bearish, whether to throw everything into the ring, or to chuck their toys out of the pram and go away. From a trading perspective, this is a weekly chart. If we pull back to daily, we can see the same thing. So if you are an index trader, this band is quite important to you because it is the arbiter of what happens to any long position you put in play. But if we look at the general health of the S&P 500, this is a chart I've shown before. You can see this is the number of stocks above the 200 period moving average. This is a weekly chart, so this looks at a long-term barometer of market health. It's not for timing, it is simply to gauge where the market is. And what it's telling me is that about half the stocks in the S&P 500 are above their 200 period moving average, half are below. So the market is at this, I don't want to call it an inflection point or a nexus point. It's simply that the market is undecided. It's neither one nor the other, and it is trying to work out what to do. But again, that's an important thing when it comes back to this notion of trading. If you're looking for a trading position, then you need to understand what the health of the market is. In terms of things that interest me in the US market, this is an ETF. This is a geared ETF, so you need to be aware of that. This is an ETF on the NASDAQ 100. And you can see this point of resistance. To my way of thinking, there is some form of capitulation in the NASDAQ at present, but again, this resistance is important. Once we punch through there and generate a signal, then I'm more confident. And in terms of broader markets, the only thing I have found interesting in commodities is cotton. And it's only interesting to me at present outside of the positions I already hold because of this congestion, this broad range. I find these very, very attractive to put away and just watch, because when they break very, very strongly. And so they grant traders an edge. And what you'll find in these, if they're accompanied by a decrease in volatility, you get this grinding down. When they go very, very hard. But in terms of final points, I want to repeat something from last week that got a bit of feedback. Traders don't understand that every time you interact with the market, you generate not only the potential for a win, but the potential for a loss. Your mere interaction with the market generates friction. Friction always comes with a cost. Traders too often go on signals that are either marginal, suboptimal, or simply don't exist, or only exist in their head. These generate a cost. That cost, whilst it seems minimal, over time adds up. And it is that gnawing away at the value of both the account and the trader psychology that is important. Patience and waiting are free. In the long term, they don't cost you anything.